This week on Wealth Track, part two of our interview with influential and refreshingly candid economist and strategist David Rosenberg on why nothing is normal in the markets right now.
Yeah, who are the buyers? In a normal rally, you have flows you can identify. But this is a short covering rally. And on top of that, there's no sellers. People are just too scared to sell stock. And I think it comes down to what you said. You know, when you hear over and over again, don't fight the Fed, don't fight the Fed. When people see, oh, well, the Fed has actually went in and said they're going to buy high yield bonds.
Right.
Well, high yield bonds reside right next to the equity market and the capital structures.
Independent thinker Dave Rosenberg joins us this week on Consuelo Mack Wealth Track.
Funding provided by Morgan Le Fay Dreams Foundation, Clearbridge Investments, a Legg Mason company, Miller Value Funds, Royce & Associates, Matthews Asia, First Eagle Investment Management, Strategas Asset Management, and Eaton Vance.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. One of the striking financial characteristics of this pandemic-stricken world is the extreme divergence between the sickening economic reality on the ground and the out-of-this-world exuberance in the stock market. How to reconcile one of the highest unemployment rates since the Great Depression with the biggest 50-day post-bear market rally in the S&P 500's history. In part two of our interview with widely followed economist David Rosenberg, he says they are not reconcilable and something has to give. In his case, he has been warning of both the stock market and economy's vulnerabilities long before COVID-19 appeared on the scene. David Rosenberg is president, chief economist, and strategist at Rosenberg Research and Associates, his independent global economic research and market strategy firm, launched earlier this year. Former chief economist and strategist at Gluskin Sheff for 10 years and chief North American economist at Bank of America Merrill Lynch before that, his daily Breakfast with Dave newsletter is considered a must-read by retail and institutional investors alike. Once Rosenberg has done his homework and is confident enough in his case, he is not afraid to make a call no matter how out of consensus it is. His bearish call in the midst of a bull market has earned him a reputation as a perma-bear, which led him to publish a letter from the non-bearish chief economist recently. However, despite the market's impressive performance since the March lows, he remains bearish, calling the experience a classic bear market rally. I asked him why.
You know, we had the vertical down. We got dramatically oversold between mid-February and mid-March. Since that time, you know, has the rally been premised on anything fundamental? No, it's really been premised on unprecedented Fed incursions into the marketplace. Buying high-yield ETFs is a very big step. And there's a lot of faith-based on vaccine hopes that are driving the market as well. But this is the nature of the markets. Whenever we have a bear market, we have an initial massive leg down. We have the reflexive rebound, which is what we're in right now, and it's very powerful. And then we have the long and drawn-out decline to the fundamental lows. And so that, for example, is exactly what happened in, for example, 2001, 2002, 2008, 2009. We had a rally off the lows in November of 1929. Most people don't know this. From November 1929 to April 1930, the stock market ripped 50% after that initial plunge. And it lured so many people thinking that, you know, we're going to be having stimulus and we're past the worst part of the shock. But people didn't factor into the fact that the shock produced a fundamental change in behavior. And the economy actually went in for another 2 years of distress. And that's not what's priced in right now. If you believe that a vaccine is coming around the corner, the market's telling you that's what it expects. I'm skeptical about that view, and I think that once we realize that the economy is not going to embark on some V-shaped, V stands for vaccine, V vaccine-shaped recovery, I think we're going to give up a lot of these gains. We're actually trading at a multiple that represents market peaks. This is not the sort of multiple you get coming into a new bull market.
You know, there's a famous saying on Wall Street, do not fight the Fed. And, you know, the trend is your friend. What about those forces that are so incredibly historically strong right now?
Right. Let me give you an example. Back after 9/11. After 9/11, the Fed cut rates dramatically. I mean, the market was closed for a few days. We had the plunge. And then once again, from November of 2001 into March, April 2002, at the time, it seems like it's going to last forever. These are like 3, 4, 5-month periods. The market soared on everything you're talking about. And the Fed cut rates dramatically. And all I heard back in the opening months of 2002 was don't fight the Fed. Well, then how come the market didn't bottom until the fall of 2002? Or, for example, let's go back to 08-09. The Fed was easing the whole way through. After Lehman collapsed, the Fed went wild on its accommodative policy. And after the plunge down in September into October of 2008, the market ripped into January of 09, went up 30%. And once again, don't fight the Fed. Well, don't fight the Fed, but then the market went down again and had a pernicious decline into the March lows. And every bear market ends, every bull market ends. That's just the nature of the cycle. I got news for you. The Fed isn't God. The Fed could certainly provide liquidity, but the Fed cannot influence what is going to be the primary risk going forward, especially if we don't get a vaccine, which is going to be corporate insolvency. And we haven't seen all the bankruptcies.
And let's talk about that. So let's talk about the fundamentals, because we're talking about stimulus, which is here to go, here today, gone tomorrow. But the fundamentals that are going to, make the economy and make corporations, their profitability strong. Talk to us about those.
I said before about, we talked about the 1930s, and we talked about all the infrastructure that went on. That had big productivity paybacks. So what we're calling stimulus today, it's not real stimulus. Whether, we're basically, the government is paying companies, I'm going to pay you so that you don't fire your people in the next 2 months. How creative is that? And we're giving out checks to people who were forced to lock down through no fault of their own. But that's not stimulus. That doesn't produce productivity, doesn't produce growth. It just basically is a bridge income assistance program to get you to the other side. And all we're going to be left with is a massive fiscal deficit that someone is going to have to pay for down the road. Oh, you see, those aren't the things we're talking about right now, but those are the things we'll be talking about tomorrow. It's a transfer from the public sector on borrowed money to the private sector to get us through this period of time. But there is going to be a significant payback down the road, and my contention is that enjoy this rally while it lasts, but we will not be able to sustain a 23 price earnings multiple in the future of what's going to be a payback for all the fiscal largesse that's been put into the system today, just to try and keep things as stable as possible.
If there are gigantic fiscal deficits, how are those going to be paid for? And so you're saying that corporations, which had a big tax cut in 2018, that they're going to be paying, so that's going to affect their profit margins. That high net worth individuals, high income individuals, they're going to be paying. That's the primary investment class. I mean, so are you saying we're seeing a fundamental change in the dynamics of both stock returns and the demand for stocks? Or you tell me what the change is going to be that is not going to be favorable to Wall Street and investors?
Well, there's just so much uncertainty right now. And I said before, look, a vaccine to a large extent is a game changer, but I just don't know. I know the history of vaccines is that it usually takes 4 years, not 4 months, to come up with one. And most of the time it's over something a lot less complicated than the coronavirus, which we found out this is not like some sort of flu. Really, we're talking about, a world going forward where there's going to have to be a payback. And yes, the payback will come at higher taxes on capital. That means that all these people that say, well, I'm buying stocks because I'm using the price earnings multiple on a normalized curve. So after all, the stock market's a long duration asset, and this pandemic and the lockdown gave a shock for a quarter or two, but didn't really impair the long-term 10 or 15-year earnings curve. Well, I say to these people, well, think about who's going to pay for these deficits. And it is going to be the corporate sector that's going to pay a big part of it. I think especially if the Democrats win in November, you can kiss the 2018 corporate tax relief goodbye. And there's going to be a lot more regulation. There is a non-trivial chance that the Democrats do take the White House and the executive branches and the legislative branches in the next election. And that is going to be a big game changer in the other way. No matter what happens with the vaccine, there's going to be some big changes in terms of taxation on capital, in terms of redistribution of income, in terms of regulation. And
you're saying that's not priced into the market at all right now?
Not a chance.
That possibility.
It's interesting that you say that, because after Labor Day, we're going to get a lot of answers to questions. Right now, the stock market has laid down its cards. It's told you what they're expecting. If we don't hear, some great announcement on a vaccine by Labor Day, because that is really what the market's telling you, that is this powerful, tradable, I still say bear market rally. We don't get some sort of announcement by Labor Day, the market's going to get pretty antsy, and I think that's when the markets start to pay attention to the election, which again is a major source of uncertainty.
Another question that you've raised to clients in your reports, which I loved, is who is buying equities? Because and you explain, when you look at the figures, the flows of money that retail investors have been buying bonds, and you said something cute as is that you, Jay, as in Jerome Powell, the Fed chairman?
Well, what's happened very recently is that the hedge funds, if you go to the Commitment of Trades report that come out weekly, that there was a dramatic net short position being built up on the S&P 500 in the futures and options pits. In fact, the net short position had reached its highest level in 4 years. So I think that, firstly, short covering, and that's when I talked about a bear market rally before. Who are the buyers? And in a normal rally, you have flows you can identify, but this is a short covering rally, and on top of that, there's no sellers. People are just too scared to sell stock, and I think it comes down to what you said. When you hear over and over again, don't fight the Fed, don't fight the Fed. When people see, the Fed has actually went in and said they're going to buy high yield bonds.
Right.
Well, high yield bonds reside right next to the equity market and the capital structure. So I get the question all the time, do you think they'll ever buy equities? So, you get that mindset.
What's the outlook for corporate profits, which usually has something to do with stock market performance?
The bulls will tell you that they don't believe the long-term profits trend line has been impaired. They believe that what's been lost now is going to be made up for in the future, and that there's been no impairment. Of course, earnings are going down easily, 40%. The downgrades have been dramatic. And I think the decline could be even more than that. And then on top of that, we're not going to have that, call it artificial support anymore, from share buybacks. So the market is actually telling you that it believes that the bulls are right, that the 10-year or 15-year normalized earnings curve is not going to be impaired. But what was very interesting in that regard is the CBO. This is like a gift from God. Was the CBO's revised forecast that they provided everybody?
Yep.
Yeah, just the other day. But what did they tell you? Well, they did tell you, look, we're in the eye of the storm. They're not forecasting an ongoing detonation of the economy. Nothing's going to zero. But it's very interesting to see their forecast on GDP is that we don't end up recouping all the decline in the economy benchmarked against the pre-pandemic trajectory till 2028. So tell me.
Oh, my goodness.
So tell me. Tell me again how that long-term earnings curve doesn't get affected by what already happened, and I think that there are going to be aftershocks. Like I said earlier, I think the big risk is that demand is going to come back very slowly, and a lot of companies aren't going to survive. I've actually run my own estimates, and I found that at least 10 million of the people that got unemployed, 10 million of the unemployed are not going to be coming back to find another job. Maybe some will find a job in other industries, but as I said, these are low-skilled, largely uneducated, low value added. I don't know what else they'll be able to do. You see, that's the thing, is that in the 1930s, they keep on coming back there. We worked with our hands. America made things, and so it's going to be very problematic to have a situation where 10 million people are going to not have a job to go back to. It's going to be a deadweight drag on the economy and society for a long period of time. It's going to be a major social problem. And so that's another risk that I think that's out there, is what does it mean? I mean, you're talking about almost 10% of private sector employment is not going to be coming back. And you're telling me that there's no effect of that on earnings in the future. Of course there is.
Where are investors most at risk in the market?
This so-called reflationary value trade has me a little concerned that there's a little too much whippiness. I can understand that.
So in small cap stocks, for instance?
Small caps, the financials, the basic materials, the industrials, the transports, a lot of the consumer cyclicals. Look at the casinos have been ripping. So a lot of the beaten down stuff has really come back a lot. Now, part of this, I think, is short covering, but part of it very recently is this view that we're getting some sort of V-shaped recovery. Well, I got news for you. If you believe in the V-shaped recovery, these are probably the stocks that you're going to want to own. We can only get a V-shaped recovery with a vaccine, and it would stand to reason, well, you know what, if we get a vaccine, hey, I'll go back, I'll fly again, I'll go to the restaurants, I'll go to the theme parks, I'll go to the casinos, I'll start to gather in crowds again. And so that's why, this reopening trade is morphing into a V-shaped recovery trade. And so the deep cyclicals, or what you call the value-oriented stocks, are starting to play a lot of catch-up. I think that it's gone too far, too fast. My biggest worry right now is that the value proposition seems to be gone a little too far for my liking. All of a sudden, in this last leg of this, you can call it bull market if you want, bear market rally, it's been one heck of a ride, I've got to say, over a short time period. The market's telling me a vaccine is coming, not at the end of the year, not next year, that it's coming by the end of the summer, okay? And so that's, I think, what the pricing mechanism is. And by the way, if we get a vaccine, it's going to be very bullish. Of course, then we're going to move on to the next thing, which is going to be the U.S. election. And the question is, well, if everything's hunky-dory, what does this do to the President Trump's election prospects? And that'll be another major risk, because the president does have a track record he has to defend this time around that he didn't have to defend last time around.
One of the things I know that we think about here on WealthTrack is long-term investing. And you think that there have been significant changes in the economy, number one, in the way we view spending, frugality, that there are a lot of uncertainties and that there are a lot of secular changes that could be occurring. So where do you see opportunities in the markets?
Right. Well,
if any.
Well, there are going to be some significant opportunities. And so when I talk about the overall market, that doesn't mean that there aren't, it doesn't mean I can't build my own portfolio, which I've done. So I'm not zero weight equities. I can't say that if I was measured against a pension fund, I certainly wouldn't be overweight. But I really invest more. My asset mix reflects thematics. After close to 3 months of isolation and social distancing and quarantining, as a society, we learned a great deal about ourselves. When you're taking a look at what are the things people bought during the lockdown period, say, beyond just, canned soup and Netflix and booze, one of the biggest selling items were bread makers. I guess that would make Martha Stewart very happy. Bicycles, jigsaw puzzles, auto parts actually did very well for retail. So all of a sudden, we became a little bit of a do-it-yourselfer society. We learned to do things on our own.
You've called your portfolio, one of your themes is that the homebody economy investments.
Yeah.
So explain, is that like a major theme of yours?
Yeah, it is. It is. And so what it basically says is that you want to buy, you want to invest in things that we need, not things that we want. It comes down also to the knowing how lopsided this economy is, that shutting down the non-essential economy was 80% of GDP. We have to restructure that and make more of what we do essential. So what I'm saying is buy essentials. Buy companies that have essential, or I would say utility-like characteristics. Could you argue, after everything we just found out, that Microsoft has utility characteristics? Yeah, I think you probably can. Amazon, or any company that can copy Amazon's business model to varying extents. Certainly, that's a utility. Maybe you can argue that Google's a utility. So you see what I'm saying here is that the distinction is now blurred.
Yes.
We talk about the 11 GIC sectors in the S&P 500, but they're also blurred right now because there are a lot of very interesting defensive growth, utility-like characteristics that exist in the tech sector. I would prefer the utilities if I'm looking for, say, yield. I think there's probably greater earnings visibility in the utilities industry than there is, say, in the financials industry, which is going to be decimated for years to come from a zero rate environment and a flat yield curve. There's just no earnings visibility there. One other area, and we got to look at, is healthcare. Now, there's always a risk, how will the Democrats treat healthcare? But I do think that, when you're taking a look at biotech or pharma, I mean, they become the solution. And so I think all of a sudden, a lot of the regulatory red tape. Look how quickly they're moving to phase 2 and phase 3 clinical trials. I mean, this has never happened before that quickly. Well, so I think that you can argue that the healthcare industry is going to be re-rated with less of a regulatory discount going forward as well. So I would say like medtech, biotech, those will be sectors I think that you'd also want to have in your portfolio.
And again, Dave, you're talking about secular changes. These are not just, temporary, impermanent shifts. You're saying that there is a sensibility shift. There are a lot of changes going on that's going to mean that it's going to be a very different environment as far as the economy is concerned and also as far as the investment climate's concerned.
Absolutely. I think that even though you could argue this was a short shock, we learned a great deal. In the 3 months of this lockdown and the pandemic, we learned a great deal. As I said earlier, over half American households did not have sufficient savings to get through 3 months of a lockdown. That says a lot right there. So how people are going to be treating their savings, and then how they're going to be treating their spending. I think there's going to be a fundamental shift away from really the years of conspicuous consumption towards just more thoughtful budgeting. Plus the fact that everybody learned how to cook. People learned how to cut their own hair. Think about that. I know people that cut their own hair. People who I knew never looked at a cookbook in their life for making lasagna. So with or without social distancing coming to an end or a vaccine, maybe by virtue of the fact that we learned about ourselves as homebodies, that we can actually do things on our own, at the margin, going out to eat is fun. Make no mistake about it. I mean, everybody loves it, so do I. But at the margin, now that you know how to cook yourself, you may just do it less. Now that you learned how to sew, maybe you don't go out and buy that sweater. You'll just do a lot of repair work at home, so on and so forth. There's no question in my mind, taking a look at one of the big sellers was bicycles. So I think the auto industry is going to be, and how do people approach going back to work? That's something else. With or without a vaccine, something else is fundamentally going to change, is work from home. Work from home is going to be a new growth industry. So anything related to wiring up your office, anything related to the utilities that you need to work from home, that's not going away. That has negative implications for commercial real estate, but it might have positive implications for other things, like having your office set up, what it could mean for home improvement. So there's offsets here. It's really almost like a pair trade. The biggest secular shift will be that we created a new cottage industry, which is working from home. A lot more of us are going to be doing it in the future than would have been the case pre-pandemic.
One investment for a long-term diversified portfolio. Do you want to help us with a home body economy pick?
If I had to pick a home body type of utility characteristic, and I'm not going to get into specific companies because I can't do that, but I would say that delivery services are going to continue to be a place that you want to invest in.
All right, we'll leave it there. Dave Rosenberg, thank you so much for joining us for a thoughtful and thought-provoking interview, as always.
Thank you.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is consider some home body economy investments. Rosenberg's thesis that we are transitioning permanently into a more frugal home body economy has some merit. Among his list of beneficiaries, which we will have on our website, are home office technologies, think the cloud, telecommunications, utilities, food suppliers, and some of our go-to diversifiers, gold and treasuries. These include some basic services which have staying power in challenging economic times. In this week's extra feature, Rosenberg tells us what lasting changes he is making because of the pandemic. To see this program again and hear previous Wealth Track interviews with Dave Rosenberg and other financial thought leaders, please go to our website, wealthtrack.com, and keep connecting with us on Facebook, Twitter, and our YouTube channel. Thank you for watching. Have a lovely weekend, and make the week ahead a healthy, profitable, and productive one.
Funding provided by Morgan Le Fay Dreams Foundation, ClearBridge Investments, a Legg Mason company, Miller Value Funds, Royce & Associates, Matthews Asia, First Eagle Investment Management, Strategas Asset Management, and Eaton Vance.